Today, we will be discussing Chapter 15, Managing Finances. Profitability ratios compare net income before or after taxes to sales, owner's investments or equity, or total assets. They use information from both the balance sheet and income statement to measure management's effectiveness in using the resources available. Profit margin percentage is also known as return on sales, or ROS. So when you see return on sales, you'll also see it as ROS. This measures how efficiently a business turns sales into profits. It tells you the percentage of sales, such as 1.8%, remaining after all of the expenses are paid. This can vary from 1% upwards of 20% in the food service industry. The formula for figuring this out is profit, the net income before taxes, divided by revenue or sales, multiplied by 100, and then that's going to give you the return on sales as a percentage. Other profitability ratios compare net income before or after taxes to the owner's investments or equity or total assets. The ROI, or the return on investment, is a measure of how well the investment into a business has paid off. This can be calculated in a different number of ways. This formula is one of them. So it's profit, which is the net income before taxes, divided by the owner's equity, multiplied by 100 gives you the return on investment, which is also known as the ROI. So for example, if we have $63,310 in profit, which is our net income before taxes, and we divide it by 628,704, which is the owner's equity, multiply that by 100, that tells us that our return on investment is 10.1%, which is average in the restaurant industry. The return on assets tells you how effectively a business converts the money it invests into net income. In the example, every dollar the business invested in assets generated 3.1 cents of net income. The higher the percentage is, the better. So the formula is profit, which once again is the net income before taxes, divided by the total assets multiplied by 100 gives you your return on assets. So we're going to have that same $63,310 in profit divided by our total assets of $2,011,646 multiplied by 100 gives us our 3.1%. Activity ratios are also called efficiency ratios, and it tells you how well assets such as inventory are being utilized or managed to produce income. Examples include occupancy rate or seat turnover. So the formula is the number of guests divided by the number of seats. So let's use the following numbers for this formula for the seat turnover. Let's say I have 600 guests that came in for dinner last night, and the dining room has 250 seats. The seat turnover would be 2.4, which means that each seat was used a little more than 2 guests during that period. So you're taking the 600, which is your number of guests, the 250, which is the number of seats, and simply dividing it to get 2.4. How do we calculate inventory turnover rate? So the inventory turnover rate measures how often a company uses and replaces its inventory during a given period, such as a month or quarter, which could be 3 consecutive months. In most cases, inventory turnover should be 3 or higher. So the formula is the cost of goods sold, and in this example, it's $99,000 divided by the average inventory value of $33,000, tells us we have an inventory turnover rate of 3. If your turnover rate is much lower than the industry average, you're probably overstocked and have some old inventory. For example, if inventory turnover is 1.5 in a school food service, that is low when many schools have an inventory turnover of 3 or higher. A low turnover rate may also occur when sales are slower. It's generally desirable to have a higher turnover rate as long as you are not so understocked that you frequently run out of items. To calculate the average inventory value for a period, you add the beginning inventory and the ending inventory, then divide by 2. So if our beginning inventory on May 1st was $34,000 and our ending inventory on May 31st was $32,000, we're going to add those two together and divide by 2 to give us $33,000, which gives us the average inventory value, so we can then use it in that formula on the top of this slide. Some other formulas for operating ratios would be the average check. To get the average check, you're going to take total sales divided by the number of customers served, which tells you the dollar amount for the average check. So if our total sales was 1,800 and we served 360 people, that means that our average check was $5. We could also do sales per square foot, and the formula is annual sales divided by total square footage of the building. And that gives us our sales per square foot. So if our annual sales is $750,000 and the total square footage of the building is 2,750, that means that our sales per square foot is $273. We can also look at sales per seat. The formula is sales for a given period divided by number of seats gives us the sales per seat. So if the number is $100,000 for sales during a certain period of time, and we have 250 seats, that means that we're selling $400 for every seat. We can then look at percentage sales by revenue center, and the formula is sales for the revenue center divided by total sales multiplied by 100. The percentage sales of each revenue center is divided by the total sales to determine the relative proportion of revenues generated by each different revenue center. For example, a university may have revenue coming in from student meal plans, a food court in the student union, coffee shops, faculty dining, catering, vending, and a convenience store. A restaurant may only have 2 revenue centers, which would be the room, aka the dining room, and then the bar area. So if we take $100,000 from a certain revenue center, we can say from a bar area, and the total sales for the restaurant is $150,000. We multiply that by 100, and it tells us that 67% of sales is coming from the bar area. To calculate food cost percentage, which we've covered a few times, the formula is food cost divided by food sales multiplied by 100 gives us our food percentage. So if the food cost was $78,157, we're going to divide that by 238,183, which would be our food sales, multiplied by 100 gives us our 32.8%. And if you do remember, we want the food cost to be around 33%. We can also look at the beverage cost percentage, and the formula looks very similar to the food cost, except take out food costs and food sales and replace it with beverage. So the formula is beverage cost divided by beverage sales multiplied by 100 gives us our beverage percentage. If we take $17,712 as our beverage cost and divide it into 76,636 for our beverage sales multiplied by 100, we will get 23.1% is our beverage cost percentage. Cost of sales percentage, the formula to calculate this is total cost of sales divided by total sales multiplied by 100 gives us the cost of sales percentage. So if we have $101,000, 204 as our total cost of sales, and our total sales is $331,492, we multiply that by 100 and it gives us 30.5% as the cost of sales percentage. To calculate the labor cost percentage, the formula is labor cost divided by total sales multiplied by 100 gives us our labor cost percentage. So if our labor cost is $121,842, we're going to divide it by our total sales, which is the same from the previous formula, of $331,492. Multiply it by 100, that tells us 36.8%. Now, if you remember, the prime costs come from your food, beverage, and also your labor, and you want to keep that around 66%, so that's where these formulas come into play. Speaking of prime cost percentage, this is the formula. So it's food and beverage cost plus your labor cost divided by total sales multiplied by 100 gives you your prime cost percentage. So our total food, beverage, and labor cost is $223,046. Our total sales has remained the same throughout all of these slides at $331,492. Multiply that by 100 and it gives us 67.3%. Our profit margin percentage formula is profit before taxes divided by total sales multiplied by 100 tells us our profit margin percentage. So our profit before taxes is $5,977 divided by 314,819 multiplied by 100 gives us 1.8% profit margin percentage. Another way of looking at costs involves examining costs per meal. Here are some examples. Keep in mind that you can also calculate these costs per patient or resident day or per student as well. So we have food cost per meal or cover, which is food cost divided by the number of meals, gives you your food cost per meal. So if our food cost is $60,000 and we have 20,000 meals that we are serving, that tells us the food cost is $3 per meal. We can do the supply cost per meal or cover, which is supply cost divided by the number of meals, equals supply cost per meal. So our supply cost is $7,000. We're going to divide that into 20,000, gives us a supply cost of 35 cents per meal. Our labor cost per meal or cover is labor cost divided by number of meals. So our labor cost is $70,000. We're serving 20,000 meals. That tells us we're spending $3.50 for labor per meal. To calculate the prime cost per meal or cover, the formula is food and beverage cost plus your labor cost divided by the number of meals gives you your prime cost per meal. So if I have $137,000 from food, beverage, and labor costs, we're going to divide that into 20,000, and that's telling us that our prime cost is $6.85 per meal. When we're talking about productivity, it is a measure of efficiency that shows how effectively inputs like money and labor are converted into outputs like meals and revenue. So increasing productivity is one of the best ways to control cost and improve the profitability of a business. The traditional productivity formula is simply a ratio of output to input. All of these formulas are to measure productivity. So we have meals or cover per labor hour. That equals number of cover or meals divided by number of paid labor hours. If we're trying to find the meals or covers per productive labor hour, the formula is number of meals divided by number of productive labor hours. If we're looking at meals or covers per full-time equivalent, we're going to take our number of meals divided by the number of full-time equivalents. And then our meals per patient day is number of meals divided by number of patient days. If we're looking at sales, we can figure out sales per paid labor hour, which would be sales divided by number of paid labor hours. We can look at sales per productive labor hour, which is sales divided by number of productive labor hours. And then sales per full-time equivalent equals sales divided by number of full-time equivalents. In order to calculate a number of productivity measurements, such as meals per labor hour, you must have a single unit of service, aka a meal. There are situations when it is difficult to accurately count meals. The meal equivalent concept was developed to solve this problem by converting food sales to meal equivalents. You can still determine a per meal cost. The most common method for calculating a meal equivalent is based on sales, such as using average check. You can also calculate it based on cost. Now we're going to talk about the spotlight on productivity of registered dietitians. To understand productivity of RDNs, first, you have to collect how much time they spend in direct care and indirect care. So you need to know the difference between the two. Direct care activities include time spent seeing inpatients, assessing, planning, monitoring care of inpatients, medical rounds, screening patient records to determine which patients need to be visited by the dietitian. Indirect care activities include staff meetings, research, staff education, travel time to patient rooms, etc. Although RDNs do spend the majority of their time on direct care activities, there is significant variety in how much time is spent in direct care activities. If we're talking about controlling costs, especially through the menu, we're going to make sure that the food cost, selling price, and contribution margin of each menu item is known and tracked. We're going to balance high and low cost menu items in order to maintain an average cost that is close to the budgeted cost per meal. So this would mean if we have a very high cost protein, we would serve lower cost vegetables and grains to compensate and not make it a really expensive meal. On the flip side, if we have a very inexpensive type of protein, then we could put different grains and vegetables that might cost a little bit more money as long as we're staying within that budget. Ensure the ingredients and inventory used in multiple dishes or recipes. Monitor the sales of each menu item and remove or change the price point of poor sellers. Take advantage of seasonal food availability and price reductions, and then balance volume discounts with food quality and perishability concerns. These are some examples of food cost control, so providing accurate recipes for each menu item. Keep accurate forecasting records. Buy from reputable and approved suppliers and use group purchasing or competitive bidding. Keep accurate receiving records. Make sure that you're logging in and out what's leaving the storage room. Purchase food closest to when it will be used. The closer it is to being used, the less likely it will spoil, mold, go bad, or be wasted in any way. Use formal requisitions to withdraw food from inventory. Monitor portion control. So we talked about scoop sizes and different portions. Make sure that anyone who is serving knows how to accurately portion out the food. Control food waste. This goes back to forecasting. Forecast how many people you'll be serving that day and don't cook extra. Supervise employees and also preventing theft. And remember, the term in food service for theft is pilferage. If we're talking about labor cost control, schedule employees to meet the budgeted staffing needs of the food service. Adjust staffing assignments to anticipate peaks, such as rush periods throughout the day. Review sales in 30-minute increments and consider adjusting staffing if necessary. Stagger clocking in and out times to reflect when and where staff are needed. Monitor clocking in and out to prevent staff from getting unapproved overtime pay. Hold pre-shift meetings to make everyone aware of all of their assignments and duties, as well as inform them about any changes. Monitor break and meal periods and personal cell phone use. Ensure that staff are performing appropriate duties for the assigned rate of pay. Cross-train staff so that each skilled person has multiple employees trained to perform the certain work. Schedule production overlap between positions. For example, if 3 cooks need chopped onions for various recipes, schedule 1 cook to chop onions for all 3, or if the substation and salad bar both need sliced tomatoes, assign to 1 staff member. So instead of having 3 cooks chopping onions, assign 1 to chop onions, assign 1 to slice tomatoes. Monitor and evaluate the workflow daily. Make frequent changes to show staff that attention is being paid to details. If you see that something is taking a really long time, maybe adjust the type of food that you're purchasing. Some principles of security and theft prevention. Keep the inventory low, check it frequently, and maintain a perpetual inventory. Secure the receiving area and storage area so you would have a lock on the door. Use group purchasing with prime vendor agreements and broadline suppliers whenever possible. Try to have contracted or cost plus pricing so that there are no surprise price changes. Use an order guide that contains the product numbers and specifications of each production used for the menu. Alarm all entrances and exits that are not meant to be used except in an emergency. Lock up liquor, wine, beer, and expensive food items in a cage, rack, or limited access storeroom. Use ID badge access to storerooms. Track sales versus inventory to make sure that you are not missing anything. And then you can always use video surveillance. Best practices for cash handling. Vet the cashiers and cash handling supervisors. Issue each cashier with a specific cash bank, so make sure they know how much is in their till. Standard operating procedures must be followed every day and every shift with regard to cash. Seek 100% accuracy. Verify voids and no sales. Do not allow cell phones at the registers that could distract them. Do surprise cashier audits. Frequent cash drops. So once they reach a certain amount of money within their till or their cash, make sure that you're pooling it so there's not such a large quantity. Designate a secure and private area for counting money and the day's receipts. Handle deposits securely and go cashless as soon as possible.